Hello and welcome. This is from the CBN. We bring to you weekly reports and expert analysis of the actions, policies, events, and economic initiatives of the Central Bank of Nigeria, CBN. I am Misi Dada. Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, and other top officials of the bank are currently at the annual meetings of the International Monetary Fund (IMF) and the Board of Governors of the World Bank Group in Washington, D.C., United States of America. The meetings, which bring together central bankers, ministers of finance and development, private sector executives, among others, to discuss issues of global concern, including world economic outlook, poverty eradication, economic development, and aid development, opened on Monday, October 10th, and ends on Sunday, October the 16th. We have part of the discussions held earlier in the week at the IMF meetings in today's package, plus a discussion on responsible digital lending and borrowing, which took place in Lagos recently. All after this break. Stay with us.
When you run a business in Nigeria, cash collection can be such a big deal. At first, it was just you and the product. And then you have a shop, then 10 more shops, in 10 different locations, in 5 different towns. Wow, that's 50 cash points. And 50 cash points could need 150 different cashiers to manage. Now, that's a big business. With bigger cash collection demands, that's where we come in. Introducing Naira Web Wallet. It makes managing cash collection as easy as ABC. Yes, 3 simple steps. We help you with 1. Setup, 2. Onboarding, and 3. Start your cash collection. With all your cashiers on point, all your customers have to do is this. Walk up to a cash point, scan the QR code, the amount, and bam! Your money is here just like that. We provide 24/7 support for any issues that may arise. We're just a phone call away, or you can also email us. No matter how much the business grows, we're here to grow with you and help you collect more cash every step of the way.
eNaira. Same Naira, more possibilities.
Welcome back. The International Monetary Fund (IMF), in its outlook at the ongoing annual meetings, says global growth is forecast to slow from 6% in 2021 to 3.2% in 2022 and 2.7% next year. Global inflation is forecast to decline to 6.5% next year and 4.1% in 2024. The fund advised that monetary policy should stay the course to restore price stability. This aligns with the current tight monetary policy stance of the Central Bank of Nigeria to hike interest rates in the face of aggressively rising inflation. At the IMF October World Economic Outlook press briefing in the United States on Tuesday, IMF Chief Economist and Director, Research Department, Mr. Pierre-Olivier Gorincha, said fiscal policy should aim to alleviate the cost of living pressures while maintaining a sufficiently tight stance aligned with monetary policy.
The global economy continues to face steep challenges shaped by 3 powerful forces: the Russian invasion of Ukraine, the cost of living crisis caused by persistent and broadening inflation pressures, and the slowdown in China. Our global growth forecast for this year is unchanged at 3.2%, while our projection for 2023 is lowered to 2.7%. 0.2 percentage points lower than the July forecast. The 2023 slowdown will be broad-based, with countries accounting for 1/3 of the global economy expected to contract this year or next. The 3 largest economies, the United States, China, and the Euro area, will continue to stall. In short, the worst is yet to come, and for many people, 2023 will feel like a recession. In the United States, the tightening of monetary and financial conditions will slow growth to 1% in 2023. In China, we have lowered next year's growth forecast to 4.4% due to a weakening property sector and continued lockdowns. The slowdown is most pronounced in the Euro area, where the energy crisis caused by the war will continue to take a heavy toll, reducing growth to 0.5% in 2023. Almost everywhere, rapidly rising prices, especially for food and energy, are causing serious hardships for vulnerable households. Despite the slowdown, inflation pressures are proving broader and more persistent than anticipated. Global inflation is now expected to peak at 9.5% in the third quarter of 2022, before decelerating to 4.1% by 2024. Inflation is also broadening beyond food and energy. Global core inflation rose from an annualized monthly rate of 4.2% at the end of 2021 to 6.7% in July for the median country. Downside risks remain elevated, and policy trade-offs have become acutely challenging. Here are a few of the ones we highlight in our report. The risk of monetary, fiscal, or financial policy miscalibration has risen sharply at a time of high uncertainty and growing fragilities. Global financial conditions could deteriorate and the dollar strengthen further should turmoil in financial markets erupt. Inflation could yet again prove more persistent, especially if labor markets remain extremely tight. Finally, the war in Ukraine is still raging, and further escalation can exacerbate the energy crisis. Our October World Economic Outlook report presents a risk assessment around our baseline projections. With 25% probability, global growth next year could slow down to below 2%, a historically low level. We've only had that 5 times since 1970. If many of the risks materialize, global growth would decline to 1.1% with quasi-stagnant income per capita next year. According to our calculations, the likelihood of such an adverse scenario would be around 10 to 15%. Increasing price pressures remains the most immediate threat to current and future prosperity by squeezing real incomes and undermining macroeconomic stability. Central banks are now laser-focused on restoring price stability, and the pace of tightening has accelerated sharply. There are risks of both under and over-tightening. Under-tightening would further entrench the inflation process, erode the credibility of central banks, and de-anchor inflation expectations. As history repeatedly teaches us, this would only increase the eventual cost of bringing inflation under control. Over-tightening risks pushing the global economy into an unnecessarily harsh recession. Financial markets may also struggle to adapt to an overly rapid pace of tightening. Yet the cost of these policy mistakes are not symmetric. The hard-won credibility of central banks would be gravely undermined if they misjudge, yet again, the stubborn persistence of inflation. This would prove much more detrimental to future macroeconomic stability. Where necessary, financial policy should ensure that markets remain stable. However, central banks around the world need to keep a steady hand, with monetary policy firmly focused on taming inflation. Formulating the appropriate fiscal response to the cost of living and energy crisis has also become a serious challenge for many countries. Let me mention a few key principles. First, fiscal policy should not work at cross-purpose with monetary authorities' efforts. Doing otherwise will only prolong inflation and could cause serious financial instability, as recent events reminded us. Certainly our advice to countries, as I've mentioned in my opening remarks, is that fiscal policy should be aligned with the objectives of monetary policy. And it's a little bit difficult if you think about central banks that are trying to tighten monetary policy, and if you have at the same time fiscal authorities that try to stimulate aggregate demands, like having a car with 2 people and in the front, and each of them has a steering wheel and is trying to steer the car in a different direction. That's not going to work very well. So our advice has always been that fiscal policy should be cognizant of the central bank's efforts and should try to be as close to neutral as possible.
Mr. Gorincha explained why the US dollar is strengthening against other major currencies and how this affects debt servicing.
Strength of the dollar is certainly putting a lot of strain on a number of countries. I mean, it works through 2 channels. One, it's making the price of imported goods, which often are invoiced in dollars, higher, and so that's increasing inflation pressures in other countries. And then it's also tightening financial conditions. A lot of corporates or governments have dollar debt, and that becomes more expensive to service as the dollar appreciates. Now, at the same time, what's important to ask is why is the dollar strengthening? What are the sources of the dollar strengthening? And here at the fund, in a sense, we're separating between what we call fundamental forces and what might be market disruptions or financial turbulence. A lot of what we're seeing right now is really on the side of fundamental forces. It's really the fact that the Federal Reserve has increased interest rates quite aggressively in 2022 so far, is expected to do more compared to other countries. And it's also reflecting the energy crisis, that a lot of energy importers are impoverished by the high price of energy, and that is reflected in the weaker currency for them. So these are fundamental forces. And in a sense, countries need to adapt to them. They need to sort of take that into account. And the appropriate response there is not to try to stem the dollar appreciation that results from this, but really to try to have countries sort of cope with it and let the adjustment happen by targeting domestic policy. Now, the second leg, if you have financial market disturbances, if you have a taper tantrum type of event, then that would justify, under some conditions, that would justify, using FX foreign reserves interventions or deploying other instruments to try to limit that volatility. But in many countries, we're not there yet.
Discussions around tackling global economic challenges continued during the IMF Capacity Development Talk on Wednesday.
As highlighted in the World Economic Outlook issued yesterday, we face challenging global economic conditions and outlook. In that context, how can the IMF capacity development support our member countries in their efforts to address both the ongoing multiple shocks while also supporting long-term transformational reforms?
It's challenging might be actually a bit of an understatement to the outlook. It is. We've been saying it's a challenging outlook for a few years now, and it was very challenging in the peak of the pandemic. But with Russia's invasion of Ukraine and what we're seeing around the world right now in terms of countries having to grapple with inflation at levels they haven't seen before, while at the same time their debt levels are going up, there's a cost of living crisis in their countries, and they have to make very big decisions about how to appropriately use their different policy instruments, monetary policy, fiscal policy, financial stability. And so in this case, I think there's one thing that's a constant and that we've always known is having good state institutions, strong institutions, having well-trained staff in those institutions that have the capacity to provide the right kind of policy advice. That is absolutely critical to navigating any time, but particularly this time. And I think it is very stark when you look at developments around the world. Because of how fragile the world is, missteps on monetary or fiscal policy can have an amplifying effect. So capacity development is absolutely critical. We do this for meeting the long-term needs of countries, but also the short-term needs. So for instance, in the middle of the pandemic, when there was the question of how to provide transfers to people when you don't want to have a personal contact, they came up with advice and training about how to do that using digital methods. But more generally, we provide capacity development for how to increase tax revenues, how to manage your expenditures on the financial stability ground. So those are some of the more traditional areas that we're in, but we also have it expanded into, I guess I would say, somewhat less traditional, but absolutely now core to the work of the fund, which is on issues of inequality, climate change, digitalization. All of this is absolutely critical for the new world that we live in, and we're involved there.
IMF First Deputy Managing Director, Ms. Geeta Gopinath, also had something to say concerning the synergy between fiscal and monetary policies.
There are best practices when it comes to how you do fiscal policy and monetary policy. And central bank independence is absolutely critical. But to be clear, this is about independence when it comes to your operational work. That doesn't mean that you don't have communication and you don't talk with the fiscal authorities. that you don't make sure that your policies are actually kind of aligned to what the goals of the country are. So I think good coordination, if you want to use that word, is basically saying, making sure that your fiscal policy is in line with what monetary policy is trying to achieve, and making sure that you're not creating conflict.
Thanks for staying tuned. You're watching From the CBN, a weekly program that brings to you reports and expert analysis of the actions, policies, events, and economic initiatives of the Central Bank of Nigeria, CBN. The Central Bank of Nigeria is working with the Federal Competition and Consumer Protection Commission, FCCPC, alongside other stakeholders to curb the menace of loan sharks in Nigeria's digital lending space. This was disclosed at the Forum on Responsible Borrowing and Lending, Balancing Access and Consumer Protection in Nigeria Digital Economy, put together by Consumatrix Integrated Solutions in Lagos last month. I had the pleasure of moderating the opening panel discussion where a former National Commissioner of the Nigerian Communications Commission, Mr. Klembaye, shared a personal experience.
Sometime last year, I don't think it's up to a year yet, I was getting a phone call from a number that I didn't know. So when I picked it, the person said, are you Mr. So I say, is there any problem? He said, we noticed you have been avoiding us. You are a guarantor for a loan, and the loan is due. And so we are going to get your bank account, and we're going to recover our money. So I thought, my personal stand is here. So I asked him that, is things like this happen? So he said, what must have happened is that the software that they use harvests the phone numbers and emails of the people that the person that borrowed. So I looked at it. Coincidentally, there is a certain gentleman who lives in Lagos who shares my first name, my middle name, and my surname. So I now thought maybe it's him I should call. So I called him. By the way, they also send text, WhatsApp messages. So I called him. I said, did you borrow money? He said, sir, these people, I was with them last week. It's 180,000. I already told them to give me another 3 to 4 weeks. I said, was that the total amount? He said, no, he had borrowed like about 400,000 and he has repaid that amount. Now that suggests to me, without taking too much of your time, because each time they now called, it was a voice recorder. He said, you cannot hide from us. We're going to collect back our money. So I now said to myself that, okay, now there is a service that is being provided, which is what is here. And from the figures and everything, it suggests that that service needs to have a better culture of managing the relationship than what they were doing. I was going to call my friends at the NCC, but I now said, listen, there's nobody that's going to go into my bank account because I didn't sign any document. And if there is a forgery, then the person is really going to get into trouble. Anyway, to cut a long story short, as it were, the chap I think refunded the money. Now I'm imagining that, supposing that there is a huge amount and we share the same first name, we share the same middle name, and we share the same surname, and we come from the same part of the country. Now, and I'm saying that I want to go to, I don't know where, Benin Republic, and I end up at the airport, and then I'm arrested for borrowing money. So all sorts of things came. So what does that tell me? It tells me that the things that we should be looking at, which I must commend the Consumer Protection Commission and also the NCC, because I'm aware of that joint something, which at least took some of the sharp edges away. But there's still a lot to be done. One, this is a thriving business. But I know that in Western style capitalism, you cannot do without pay lenders, loan sharks, and the rest. What you try to do is to ameliorate them, to moderate their influences, because they are necessary in the society.
To my understanding, there is no specific law guiding or regulating digital lending in Nigeria. From what you have seen, from what you have said, what effort is FCCPC putting in place to make sure that there is regulation? And what is your relationship with the CBN? Because CBN has BOFIA, which puts banks and fintechs under them to oversee. And that brings to question, what is the scope of FCCPC then? So you tell us your relationship with the CBN and efforts being put in place to ensure there are laws enacted to guide and regulate digital lending in Nigeria.
Thank you, ma'am. CBN is an arm is a part of government. CBN is part of the task force, the joint task force. So part of what was discussed, part of what was the agreed process initially was for those money lenders that actually are money bank, deposit money banks, is that how you call them, that are licensed by CBN. Obviously, for they to be licensed would mean they already are under regulatory supervision, and so if they are found wanting, what we had agreed to do as a joint task force was that we would use CBN in effect would carry out its role as a sector specific regulator to bring about compliance and so on and so forth to remedy that situation. And so of course CBN being part of the joint task force and allows us to leverage on also regulations that are from the CBN, that in a situation where these companies are found wanting in certain areas, the relevant regulations as domiciled with the CBN would be applied to bring about the necessary regulation, supervision, and corrections that would be required. Those licensed under the CBN would be dealt with, so to speak, by CBN. We would also leverage on the regulations that are domiciled in CBN to see that these issues are addressed. And then the ultimate objective is to ensure that there is in place a comprehensive regulatory framework and strong regulatory framework that would allow to sanitize the space. Now that is in the joint task force is in process of putting together this comprehensive regulatory framework with all the relevant agencies that I mentioned in the task force playing a part. In the meantime, what we have are interim and limited rules that every fintech company that would seek to function as a digital money lender would have to what do you call it? We would have to comply with. Otherwise, they clearly, when those regulations as have been exposed, would clearly mean that they're operating illegally. So either way you look at it, either you're licensed by CBN already, or you're functioning as a money lender, digital money lender, you would have to comply with the interim rules. So that's where we're going. But ultimately, the aim is to establish, to ensure that there is in place a comprehensive regulatory framework for that space, so that we'll be able to harness the positives. Because like has been mentioned earlier, they bring tremendous value to the economy. And that's the way the world is going anyway. But we cannot say, because we're trying to, we cannot, how can we chase them? How many can we chase and get? Just one alone would transform, keep transforming, and you're doing your bit to keep up, but then there are so many. So of course they would also see the benefits in as a business, like Mr. Clem had said. They will see the benefits as a business of coming out to work transparently, having the proper business model as he has spoken about, so that they would reap the benefits that the sector itself brings, and at the same time bring the benefits to the citizens and also develop our economy in the right manner.
The culture of lending and borrowing, particularly in the digital space, needs to change. That's all from the CBN this week. Report on resolved banking issues to the CBN Consumer Protection Department via email using cpd@cbn.gov.ng. Attach relevant documents. Call the CBN Contact Center on the phone line +234 700 2255 226. Local call rates may apply. For inquiries and comments, use the email address fromthecbn@gmail.com. Follow us on Facebook, YouTube, Instagram, and Twitter for updates and to watch uploaded episodes of the program. We invite you to join us again next time. I am William Misik Dada. Stay safe. Bye for now.